What's up, media fam? All right, so today we are talking money. Today we're going to talk about the different types of income you can generate. If you can recap, on Tuesday, we talked about how it was important to generate multiple streams of income, get as much income as you can in your portfolio, but it was more important to retain that income, understanding how it was to not only retain it, but to compound that income. So today we're going to talk about just the different types of income and how to multiply yourself so that you have the ability to have multiple sources of income. I know you hear people say all the time, you need to have 3 streams of income, 5 streams of income, whatever your magic number is, it really doesn't matter. What's important is that you are having multiple streams of income so that you can accumulate wealth that much faster. Why work so hard in one place when you can have it in several opportunities and areas? Now, what are the types of income you can generate? Of course, is the old-fashioned earned income, the blood, sweat, you working for it. So either you're working for an employer, you go to a job, you get paid wages, and that's your income. That income is not so attractive. Why? Because you have to work for it. You have to get up and actually commit some physical labor. So no one really wants to do that. Everybody wants to take a different route and generate income, but it's the way we start out. It's the way we're most familiar with. So you go out to a job and you generate income. You can also decide, hey, instead of going to work for someone, I'd rather work for myself and start my own business. Guess what? That's also considered earned income. It's really no difference as far as the allocation of the income. From a tax perspective, it's all earned income. You're getting up, you're reporting to a job, whether it's your job or your place of business, you have to work for that income. And from a tax perspective, you're paying that FICA tax that you have to pay. So you're going to pay your federal income tax, your state income tax. Depending on your state, you may have some local taxes, and then you have to pay what's considered Medicare and Social Security combined. It's called FICA taxes, which is about 15.5%. Now, the beauty of working for an employee versus an employer when it comes to FICA taxes, that as an employee, you only pay that 7.5% tax because you have to split that tax 50-50. Whereas if you're the employer, the business owner, you're paying both sides, the employee and the employer side. Now, if you own a business, there is a great way to create passive income, which is a second type of income. So you have earned income, now you have passive income. Passive income is basically if it's income you don't have to work so hard for. So if you have a business, let's assume you're partners with another business as an investor, and you don't actually go in and you work towards the business, but you just lend your money or provide your financial resources. That's a way to generate some passive income. You don't have to commit any physical labor, you just have to commit your pockets. That's passive income, and it's a great way to avoid paying that 15% tax. And it's great money. You don't have to physically apply any labor. You can also have rental properties. Rental properties is a great way of generating passive income. So you absolutely can generate it that way as well. But passive income, love it. There's also portfolio income, or others may know it as investment income. That's your income that's generated from capital gains. You can have different stocks, bonds, mutual funds, ETFs, whatever it is, you can have income generated by those streams as well. I love passive investment income, portfolio income. Everyone should have some sense of investment income in some shape or form. Many of you have it in your retirement portfolios, 401ks, Roth plans, those type of plans that also are considered investment incomes, but the tax implications are different. So you have to be cognizant of, yes, I have investment income, but how that income is generated as an investment vehicle also will differentiate how the taxes are applied and paid. So you want to be sure about that too. There's also tax-free income, which also usually generated from investment income, but from a tax-free source. That income can be great income because you don't pay any taxes on it. However, it generally has the lowest risk, and therefore low risk, low rewards. Now, don't misconstrue the fact that just because it's low risk and low reward, that it's not worth having. Oftentimes, the effective rate can actually benefit you better than actually having a tax implicated investment, because if you're paying taxes on certain returns that have greater risk and greater reward, you may be paying more taxes, versus not paying any taxes at all on something paying lower risk, and the effective tax rate ends up balancing itself out. So pay attention to the numbers and look at your cost of capital, your cost of debt, and your cost of returns to see which one makes the most sense. It may be very cost effective to have a tax-free investment vehicle, including your portfolio, and it gives your portfolio some great diversification and balancing. So don't oppose yourself to tax-free income. And then lastly, there are two other streams of income that you can generate. There's insurance incomes that you can accumulate. If you have insurance proceeds coming in, unfortunately, someone passed away, however, they left you a life insurance policy, you don't pay any income taxes on those proceeds. However, you do pay taxes on any interest income that is earned and generated from those proceeds. And generally that's classified as ordinary income. So remember, ordinary income is income generated either from a business or certain investment vehicles, but you don't have to pay that 15% taxes. Sometimes, not all the time. Remember, LLCs, S corps, those are considered ordinary income too, just so you know. However, you may or may not pay 15% depending on if you're working or not working. So keep that in mind. People get confused with the definition of ordinary income. Ordinary income can apply to both earned income and passive income. It just depends on the nature of the business and the nature of the income. And then there's also gifts and inheritances. That's the last stream. And of course, we love getting gifts. Who don't love getting gifts? I love getting gifts. Christmas is my favorite time of year. But keep in mind, gifts is another great way to avoid paying taxes if it's done right. If it's not done right, you can end up paying some taxes even on your gifts and inheritances. So just be cognizant of that. There's one last type of income, but we're not going to talk much about that. And that's your illegal income. And quite frankly, if it's illegal, you're probably not telling anybody that you've generated that income anyway. But technically, Uncle Sam's won the chunk of that too. So you're supposed to report your illegal income. I find that to be hilarious, but you are supposed to report your illegal activity income and pay taxes on that too. Good luck with that one. Anyway, so those are my nuggets for today as far as the different types of income you can generate. Make sure that you are multiplying your sources versus multiplying your labor. Be smart about the income you're generating. You don't necessarily have to be in so many places to generate these incomes. You can have different portfolio incomes, investment